The perfect storm. What is it? In the language of finance, it typically indicates an uncommon confluence of unfavorable events, and hence, cause for concern. Today, I'd want to discuss how the current state of affairs for Bitcoin and the cryptocurrency industry represents a similarly uncommon but, this time around, incredibly advantageous perfect storm. Numerous reputable institutions have shared their analyses of what Bitcoin might be valued in recent weeks, now that the asset class is becoming more widely accepted. Crucially, the sheer quantity of potent catalysts that will increase demand for this already rare and underinvested hard asset is what drives these calculations rather than hype. Many major financial institutions currently predict that the price of Bitcoin will rise dramatically over the coming years, with price goals ranging from almost triple the coin's all-time high to reach $160,000 to as much as $1 million per coin. These price projections are supported by a number of strong factors, the most prominent of which is the impending supply shock caused by a halving that will occur in April 2024, coinciding with the legal approval of spot ETFs, which would generate a surge of demand from institutional investors. In short, we have a situation where the first-ever four-yearly supply crisis for Bitcoin is occurring simultaneously with the release of a massive surge of institutional demand. An increasing number of credible analysts believe that Bitcoin may hit 6 digits by 2024 due to a convergence of circumstances that will both limit supply and enhance demand. The fact that Bitcoin has already increased by 160% in 2023 thus far serves as evidence for this. The most obvious factor anticipated to drive up Bitcoin prices is the impending April 2024 halving event. The incentive for mining new blocks in Bitcoin is designed to be reduced by half about every 4 years. Increased scarcity has historically always resulted in a considerably higher worth since fewer new coins are going into circulation. Since its previous halvings, Bitcoin has had substantial rallies in each of the 12 to 18 months that have followed, see Pantera's chart above. Therefore, it is reasonable to anticipate that even on its own, the impending supply shortage in 2024 will have a comparable effect. However, this time is truly unique. Apart from the reduction of the new Bitcoin supply by half, more than 13 significant financial institutions, such as BlackRock, the largest asset manager globally, are currently preparing applications for Bitcoin spot ETFs. The approval process is expected to begin as early as January 2024, and there is a 90% chance of success, according to Bloomberg. Almost immediately, the SEC's approval could unleash a wave of fresh institutional demand. After the much-awaited approvals of the ETF, former Coinbase CTO Balaji Srinivasan has also forecast seven-figure Bitcoin prices. The main reason for the enthusiasm is that institutional investors would now have a convenient way to invest in Bitcoin thanks to the ETFs. Remember that the number of people using Bitcoin wallets has been increasing rapidly over the past few years, mostly individuals rather than organizations, and it makes sense that the increased liquidity and exposure that ETFs would provide would encourage the inclusion of more users. The macro backdrop's stars also appear to be aligned for even more upside, with the Fed expected to resume rate cuts by 2024. Riskier investments such as Bitcoin typically benefit from lower rates. In addition to the fact that riskier asset classes, such as technology stocks and Bitcoin, generally do well when monetary policy loosens, it is also evident from the reputable research of former Goldman Sachs macro specialist R. Pal that crypto actually functions as a multiplier in more lenient monetary environments, often outperforming even technology stocks. All things considered, it should come as no surprise that analysts are very optimistic about Bitcoin's price trajectory over the coming year, given the combination of spot ETF approvals, the impending halving, probable Fed rate reduction, and expanding mainstream usage. While six-figure forecasts were considered unusual at first, they are now typical. Believe that greater scarcity combined with skyrocketing demand might make 100K plus Bitcoin a reality much sooner than most people imagine. Since early October 2023, Bitcoin has seen a monstrous 50% rally. This indicates that the market is beginning to agree and is placing bets on the impending approval of ETFs in the next weeks. Since it would offer the approved ETF a first-mover advantage, I think it is improbable that the SEC will accept only one of the 13-spot ETF applications it is now examining. The SEC is more likely to approve many ETFs at once. This implies that multiple new cryptocurrency offerings from major players like Grayscale, Fidelity, BlackRock, and WisdomTree would launch simultaneously. These 13 companies control $17 trillion in total assets. Remember that these companies are experts at creating demand for financial products through marketing. After the introduction of the first gold ETFs, the market for gold-related financial products expanded by 8 times. Imagine, in addition to the massive wealth advisor network connected to these financial behemoths, there will be a barrage of advertisements to go along with these product releases. Up to $70 billion in fresh cash is predicted to come into Bitcoin following the introduction of a spot Bitcoin ETF, according to blockchain data startup Glassnode. Maybe the uncertainty is in how swiftly it appears. My hypothesis is that capital has entered the market earlier than it normally would have due to the strong recent Bitcoin surge. The upcoming April 2024 Bitcoin halving will reduce the amount of new coins issued by half to 450 each day. This will then cause the demand side of the Bitcoin issuance to increase to 10.3 years, with demand chasing supply for a whole year. The U.S. Financial Accounting Standards Board, FASB, proposed new guidelines in October, which may serve as a significant impetus for corporate demand for Bitcoin. The FASB sets the guidelines for U.S. corporations reporting their financial status in accordance with GAAP, or Generally Accepted Accounting Principles. More precisely, it established guidelines for how businesses should disclose their Bitcoin holdings on their balance sheets. According to current guidance, the business must reduce the reported value of its Bitcoin when the price of the cryptocurrency it purchased falls below the purchase price. If the price of Bitcoin rises later, the corporation will not be able to increase the value of its Bitcoin. Therefore, under the current regulations, Bitcoin remained a black mark on balance sheets even during significant rallies. Companies like Tesla, TSLA, and Block SQ are initially among the largest winners of this regulatory change, according to a report from Yahoo Finance last week. Companies holding Bitcoin like Block and Tesla are required by the present accounting rules to declare a loss in their earnings reports if the value of the digital asset declines over a specified period of time. If the price increases, they will also be unable to record a profit. In actuality, this implies that even if the price of Bitcoin immediately rises to $40,000, a business that purchased it at $25,000 and watched it drop to $20,000 must keep the lower value on its balance sheet. At midday yesterday, the price of Bitcoin, which surged in response to the FASB announcement, was slightly over $42,000. However, we are discussing more than just the fate of these two businesses. The main effect of the new accounting rule is that it increases the allure of holding Bitcoin as an asset on a company's balance sheet. Longtime supporter of Bitcoin Michael Saylor, CEO of software company MicroStrategy, has been pushing for this transformation for a long time. Saylor has amassed a $5 billion holding in Bitcoin in his company's treasury. To put it briefly, anyone familiar with the workings of blockchain technology and their transparency will find it absurd to believe that terrorism is being supported by cryptocurrency. Unfortunately, the truth is that the traditional banking system likely receives far bigger amounts of funds for terrorism because it is opaque and hence simpler to hide, something that any smart terrorist would know. Hope you liked the video. Please hit the bell icon so that you can stay tuned for upcoming videos, and don't forget to like, share, and subscribe to the channel.